Okay, we want to welcome everyone back to another episode of Loans Elevated. Today we're going to be talking about credit. I mean, it's one of the number one questions I get when filling out a loan application is everyone's nervous about like credit. It's taboo. No one wants to talk about it. You know, they're like, hey, FYI, my wife doesn't know this is on my credit. No, I'm just kidding.
Yeah,
but
that's when we push the clock to our hourly charges.
Right.
Therapist,
Exactly.
That's a different topic.
But no, what's like the number one question you get asked on credit?
Oh, I mean, that's easy. The number one question is, hey man, I don't want a hard credit pull because it's gonna drop my credit.
Oh, dude, I get that.
Is that the same for you?
Like multiple times a week.
Yeah.
I mean, the reality is when we do a lot of applications every year, and not once have I seen the score affected just because we're pulling credit.
Literally thousands of applications per year, in the thousands. And we've never, I've seen tens of thousands in my career. We've never seen that happen. Somebody's credit doesn't drop because of the inquiry. Now, here's a couple of little thoughts here. You can see your credit get pulled by one lender and be different shortly thereafter pulled by another lender. And chances are the verbiage on the report will say your credit isn't as good as it could otherwise be because of too many inquiries. So number one, that I actually had an older couple come to me. They literally had perfect credit. It was flawless, exactly what an 850 credit score would require on the report. They came in, I pulled their credit, it was like 845. So it wasn't 850, it wasn't perfect. Why? Normally there's 4 reasons why your credit isn't as good as it otherwise could be. They only had one. Guess what the one reason was?
Was it an inquiry?
Too many inquiries. There was one inquiry ever, in the past 2 years, and it was mine. And that's the reason their credit wasn't perfect. But you can't ever get your credit score if you don't pull your credit, right?
Is there ever a case where you can have too many inquiries?
Oh, for sure.
So where does that barrier stand?
Well, you remember when I've told you this story. So I got my credit pulled. I bought a truck and financed it years ago. This was, I don't know, probably 10 years ago or so. And I'm at the dealership negotiating hardcore and trying to get the best price. And then at the end, I finally negotiate the price and I'm financing it. And they're like, do you want us to get you the best rate? I'm like, well, yeah.
Of course, I want money.
Yeah, I want the best rate. Well, that's as far as it went. Do you want us to get you the best rate? They end up getting me a great rate. I'm super stoked, got a great price on the truck. Another month later, I was doing something on my mortgage. So my credit gets pulled and my credit is always optimal. Like, high 7s, low 8s. It's always in that range and has been for years. It comes back and it's like 720. And I'm like, what is going on? There was 2 reasons for this. Number one, I had a balance on my credit card. I paid off the balance and instantaneously with a rapid rescore, my credit got back up to like 740, but still that's low for me. And what I found out was after a couple of years, I got back up into the 780 to 800 range. And the reason being the best rate required them, well, I guess didn't require them, but what they did is get my credit pulled 20 times in one day. So 20 pulls with all 3 bureaus. So there's 60 inquiries technically with all 3, with a combination of all 3 bureaus. That dropped my score. But the reality is it only dropped my score like 20 points.
Right, and there was that many inquiries.
20 inquiries in one single day. So there can be a limit to it, but getting your credit pulled once, twice, 3 times when you're pre-approving for a house, doing your due diligence, that happens. No, and it happens like, I would literally say, at least in my world, 90% of my clients have had their credit pulled at least one other time recently.
Right. Well, I mean, that leads into the next thing. When I do pull a client's credit, and I'm sure you get this all the time. Hey, Broch, I just checked on Credit Karma, and my score was 810, and you're telling me it's only 780?
Yeah.
Why is that?
So I want to make one little comment here. Credit Karma has actually, lately for me, been giving consumer credits scores lower than what our mortgage score is. So I would say, by and large,
that can be flipped.
And on Credit Karma right now, it's pretty much always flipped,
for sure.
Which is crazy.
Yeah.
But the point I think you're making is, you guys pull a consumer credit report, which would be a Credit Karma, or your credit union offers you a credit report, or your credit card company, whatever. Those are consumer reports. We pull a mortgage report. Auto companies, like credit unions, pull a different report if you're getting an auto loan or a credit card or whatever. There's a multitude. And the reality is there are, there are
55
different algorithms between the bureaus. So we may have like a TransUnion FICO Classic version 4. I'm not perfect there, but we have a very specific version of the credit report with TransUnion, and then Equifax will have its own, and Experian will have its own. The credit union may pull a Vantage score. Well, that's actually what the consumer ones are. So there's algorithms that weight things differently. So you can't ever, it's a good guide and gauge to what the credit trend is doing. Is it going up? Is it going down? Is it staying flat? But it's not a good judgment of the actual score. So getting your hard inquiry is important. One, because it's not going to impact you. Two, it allows us to give you a legitimate, accurate pre-approval rate quote and analyze the options properly. But three, you actually know what your credit score is. You might tell us it's 720, maybe it's 740. That can have an impact on your rates. Or vice versa. You may say it's 800, we pull it, it's 710. That could be a big deal and totally change the approval.
Definitely.
So,
I mean, how can a consumer be conscious of how to work on their credit? Like what makes up the credit mix? I mean, we've got your credit mix, we've got payment history, utilization. Let's unpack those and dive into those a little bit. Okay,
so credit mix would be how many, and this is about 10% worth of the overall score. So if we look at the score, there's 100% that makes up the score. This makes up about 10% of the score. And credit mix is how many different accounts do you have? Do you have a credit card? Do you have an auto loan? Do you have a student loan? Do you have a mortgage? If you have all of those going for multiple years and they are all paid on time, that's going to be valuable. So the credit mix is important, but I would say probably the least important thing. Like correct. You could legit have a credit card only and have a 780 FICO.
Yep, and there's, you've got your installment loans and those are your auto loans, you've got your revolving loans and those are your credit cards, and then you've got your mortgage, which is of course your house. Now, what's really important is payment history. That's like 33%.
Yeah.
It's really especially important that you're paying your payments on time. Just one missed payment can significantly impact what happens with your mortgage or applying for any credit in the future.
Even actually insurance scores. So auto insurance and homeowners insurance, they pull a version, one of these 55 algorithms of credit, and even lower credit can cost you more on homeowners insurance. So payments are important, but one thing is, you aren't late. If your payment was due on the 1st and you made it on the 2nd, you are not considered late. This is only 30 days late, or 60 days late, or 90 days late, so on and so forth. It's basically 30, 60, 90 plus is how they rate it. And the further out you go on a late payment, the worse this is on the bearing of your score. But it's by far the biggest factor in credit scoring.
Yeah, and one that's almost rivals that is your card or utilization. I mean, I see this in my personal credit. I know when card balances are higher versus when I need to pay them off. I can see my credit going up and down
instantaneously.
Yep, exactly.
Like I actually mentioned that in another episode, which was I was applying for a mortgage and they pulled my credit. It was very low. I'm prideful of my high credit, like most people are. It was very low. And they pull it and I'm like, what in the world? There's no way I have a 720 credit score. Well, they do a what if simulator, which is we can do that. So if we pull your credit, which is another good reason why we should do a hard inquiry, because then we can pull your credit and we can analyze based on the actual credit bureau's software what you can do to improve your credit. So that's what this lender did for me. It's before I was in the business. And they said, well, if you just pay your Amex down, it had like $5,000, just the regular monthly spending, had $5,000 on it. I paid it back down to zero. My score instantaneously, like within a week. It takes us about a week to get a rapid rescore. So I pay it off, get a letter from the creditor. I submit that to the lender, we submit it to the credit bureau. And then within about a week, 5 days, something like that, we have a new credit report back with a new score. My scores jumped with one single change, just paying down the credit card. My scores jumped by like 40 points. So that is a huge, could be a very damning factor, but a very simple fix.
Yeah, well, and oftentimes I get clients like, well, before you pull your credit, I need to pay down this card by X amount. I'm like, well, actually, let us do that for you. We'll tell you exactly what you need to pay that card down to, and we get a rough range, usually 5 to 10 points of what your score is going to come back to.
Yeah, and I would say it's even closer, like 1 to 2 points. Yeah, something like that. And one thing is, which is crazy, depending on the credit mix, so this is where this can come in, the credit card balances will impact you differently. So some people that have a breadth of credit, they have a lot of different credit accounts, they will, paying their accounts all the way down to zero on the credit cards, may be the most optimal thing and get them the highest credit score, but paying them for somebody that doesn't have a breadth of credit, it's actually oftentimes better and sometimes significantly better if you pay everything to zero and maybe keep like $100 on your $1,000 credit limit credit card. That's better than having them all at zero, which is crazy, weird. We don't understand it entirely, but we have the tools to identify those issues and details. So I would say definitely don't go at it alone.
Yeah.
Like, we don't charge you anything to do all this work, to just optimize and perfect your situation for buying a home, which is powerful. So yeah,
Right.
that's huge.
Is there a ratio of that utilization that's best, like 10%, 30%?
Sometimes that's a mystery. I think it's not perfect, but I would say they go in the range of less than 50% is critical, less than 30% is good, less than 10% is optimal. So if you've got a credit card that is $1,000, you have $100 charged on it, that's optimal, or $90, or somewhere between $1 and $100 in that scenario.
Especially if you have zero to no new credit, and I'm sure you can find promotions out there with extremely low interest. You can have that $100 balance and be paying your minimum payments, and you will see your credit go up quickly.
Yeah. And one other thing with the utilization, it is important from a account to account basis. So each account should have a low utilization, but then globally, all of your revolving accounts should also have a low utilization. So if you had a $1,000 card and a $5,000 card, it would be bad if you had 5,000 or 4,000 charged on that. You really want, now you have 6,000 in total available credit. Ideally, you want all the credit cards balances together in that scenario to be less than 600 to hit that 10% optimal balance.
Yeah, that makes sense.
Yeah.
Makes sense. Cool. Narrowing it down, this one's not as important, but it is still important. Length of credit, making sure you have that credit history.
Yeah.
Why is that important? Banks
I don't know.
want to
It's all a
see
mystery. I think certain loan programs do require you to have a certain, like, what is it, three accounts that have been reporting for at least the past 12 months. So you can actually not even if you have an 800 credit score, you could be disqualified from certain loan programs because you don't have enough accounts with enough time reporting. So that could be an issue. On standard financing, like conventional FHA, VA, USDA, some of the standard stuff, jumbo is where those more unique details kick in. But the standard stuff, I've got clients that are, just barely out of college. They may have one car loan and maybe a credit card, or a student loan and a credit card, and they've only had those for 2 years because they didn't have debt before. They still have an 800 FICO, and they get all the benefits for it.
Right. Yeah.
So it's not super important. But.
And then every time you add on a new account, it's also going to affect your score, but it's not going to be permanently. Same thing with closing an account.
Yeah.
Every time you're adding or subtracting an account, you will see your score affected for a couple of months, but it should go back to normal after that's passed.
Yep. Yeah, that's a big thing. Back to our point of the simulations and us guiding you through the best ways to handle the credit accounts that you have. If you go and pay off a collection account, for example, which is a derogatory account, maybe medical collections are actually falling off this month, July 2022. They're falling off of most of the bureaus, and there's, I'm sure, a lot of details that we don't understand yet because it's brand new, but that's cool. But oftentimes people will say, well, I want to go and pay off all my collection accounts. That could be we may actually tell you to not do that, because if you do that, you pay that collection account that's $50, so it doesn't cost you much. You think it's better for your score. What happens is you pay that off. The date of last activity is updated to this month. So it could be an account that was 3 or 4 or 5 years old, and so the activity is becoming dated, but you pay it off this month, they update it, and boom, your scores go down, even though you paid off this account.
Yep.
So the way around that, why don't you tell them the trick if they do want to pay off a collection, and there is ways that we can get it up. What is that letter that we asked for?
Yeah, so for sure, like, you're gonna want to get what's called a deletion letter, and use this to your power. They obviously, if you have collections, they obviously want their money, but you can say, hey, if I pay this off, can I get what's called a deletion letter? And that will delete it off your credit as if it was not there. And it's huge, and it really helps your score.
Yep, and we can handle that through the rapid rescore. It happens in like a week. You got to be cautious though and strategic. You got to put your sales hat on. You probably have to escalate through multiple layers within that creditor's company. You got to get a manager and explain the situation, because the fact is, most clients we talk to, the collection account is not, there was no intent in going late. It's like they mailed the bill to the wrong place or whatever. So you got to work your way up the chain. Some of them will just simply not do it because they say it's against the law. And they don't negotiate basically with terrorists is how they act. Yeah. Sometimes they're like, no, I'm not, no way, we're not doing that.
Sometimes you have to escalate it.
Yeah.
You might have already mentioned that, but you might not be the first person you call.
Right.
Get you the deletion letter.
Yep. And they may just not be very willing to give that to you. Even if you're willing to chalk up the money and pay it, some of them won't do it, but it is a strategy that we can really help improve scores with.
For sure. Is there anything else on credit that we missed?
I don't think so.
Cool.
I would say the biggest takeaway is use us as a resource. Yeah. Like I said, it costs you nothing. We offer a one-on-one consultation, a full-blown mortgage plan for free. We pull your credit, we give you all the tips, we create a strategy, a roadmap to get you into homeownership, optimize your situation. So I would say, like, I've spent the past 14 years doing this. Tej, you've been in the business now like
5 years.
5 years. This is all we do. We live, eat, and breathe this stuff. Leverage us. There's no point in not. It costs you nothing. We'd be honored to help.
Definitely. And if you found this useful, please share this episode with friends and family. And also follow us at Loans Elevated on Instagram or any platform for that matter.
Awesome.